And with just a few trading days left in 2022, the S&P 500 down 19% on the year, saw its worst year since 2008, as a vast majority of stocks fell into a bear market under the weight of rising interest rates. And I'm looking at the Wi-Fi Interactive. I actually just tweeted this out a little bit earlier. I went to some of the more popular markets here, including the S&P 500. Rattling off that stat there, down 19% year there. But in 2008, it was down 38%. That was the global financial crisis, arguably worse by 2 times that year in terms of performance. XLK, that's the tech sector, that's down 28% this year. 2008, it was down 34%. You'll notice that in 2008, the overall market was down a bit more. That's because tech was not the culprit back then. But you take a look at consumer discretionary, that's XLY, down 36.5% this year. All-time worst by a small margin, was down by a similar amount in 2008. Apple, 2008, it was down 57%. Now it's down about half of that, 26%. Tesla, worst all-time. Amazon down 49%, half of its value. But in 2000, when it was a fledgling stock, third year of public company, performance was down 80%, was also down the next year. So we've seen some of this before. But Julie, I know you were tracking some of the performance forecasts of various high-profile members of the analyst community here, and they didn't quite get this year right.
No,
well, as we didn't.
I titled this this graphic. I suggested the title "Forecasting is Hard," right? Because it is to figure out where we're going to be at the end of a year, especially a year that saw, for example, the Russian invasion of Ukraine that was not forecast, that saw some of the feedback effects post-pandemic and the effects on the supply chain that, we talked about what were difficult to accurately forecast. You had a year in which the Fed thought that inflation would be transitory, and it just kept keeping on. And so all of that means that the average forecast, if you go back to late November of 2021, and the forecasts as compiled by Bloomberg for Wall Street were for the S&P 500 to finish this year around 4,800. The high was from BMO's Brian Belsky at 5,300. He was quite optimistic. Mike Wilson, as he's become known, was pessimistic, but he wasn't pessimistic enough that point in time, 4,400. So it's quite interesting when we look back and sort of knowing what we know now. And obviously these folks then adjusted their forecasts throughout the course of the year, as they do. But still, it's always instructive to go back and see. And during the rest of the week, we're going to look ahead and see what their forecasts are right now for the end of next year. And then we'll do the same exercise all over again.
Yes, rinse, repeat. I don't want to say that. That kind of takes some of the luster out of what we do here. But just a quick comment on that. It blew my mind that Mike Wilson was the low ball, and it was 4,400. Now we're sitting at 3,800 and change here in the S&P 500. Just goes to show you how much things can change in 1 year here. I had one other thought here. So Mike Wilson was really a leader in the bear market case this year. And early on, too, he saw the Fed pivoting. Now, not the pivot that we're talking about here, the original hawkish pivot. Don't forget that the Fed already pivoted this year. They're going to pivot next year, maybe. But so he saw that with a lot of clarity. And then over in the I think it was Michael Hartnett over at Bank of America, really had a lot of the tactical calls going his way this year, the ins and outs, the ups and downs with the vicissitudes within the market. And then Kalanovich over at JP Morgan, this was one of his worst years in a while. They call him Dr. Market for a reason, but he was one of those guys who was buying the dip early on and didn't really leave that mantra until later in the year. Yeah,
one more thing I want to mention outside of stocks, because now going into 2023, the big call seems to be fixed income.
Yes.
And just a reminder that fixed income had a terrible year in 2022, whether you're looking at the corporate bond market as measured by the Ag Index, or whether you're looking at treasuries. There's the treasury total return and the negative return we saw. And that's why, just to refresh people's memories, that's why it was such a tricky year for many investors, because the usual area of refuge, which was here, was not a refuge at all in 2022. The 60-40 portfolio was not working.
Yeah, excellent comment there. Not a lot to add to that, but you do really have to consider the double whammy that was caused by losses both in the stock market and the bond market. When those two happen, it's usually centered around a huge game-changing event for the Federal Reserve, like we saw this year. So the Fed having to change course, pivot up to the upside or the downside, that usually changes the game for equities or for bonds, and then it's a double whammy for the investor returns.
Yeah, so we'll see what happens in 2023.